What is going on, investors? Are you guys excited after that big move on Friday? It was pretty nice, right? This could be it, right? We're out of the mess. We're done with the bear, right? No? Nope. Wouldn't be making this video if we were. Yes, I'm sorry, but chances are we're gonna make another new low. It sucks, right? Every time you think you're out, those bears just keep pulling you back in. But in this video, me, AK Fallible, I'm gonna explain why I think the market might hit a new low before continuing on its bull run. So yes, technically the overall bull trend is still intact, but this isn't the resumption of it. I'll explain why. So as I said, the S&P 500 had a nice bounce off its short-term bottom. And from here, we should see it run up into the 2600 range. That's where its 50-day moving average is, as you can see by this red line. But right around where that red zone is, there is a lot of overhead supply, which means there's a significant resistance. Because a lot of people who bought in that range, they're underwater right now. So they're going to be the ones who are looking to sell when the market reaches that point again. And that's what I mean by overhead supply. So with huge resistance areas like this one's, it typically takes the market a number of times to try and break past it before it finally does. The supply has to be worked through little by little. So we can probably expect to see a reversal around the 2650 to the 2675 range. And from there, that's when we would see the sell-off to a recent or even a new low. After large sell-offs like the one we just saw, double bottoms are typical. And there's some reasons why we think this is going to happen. For example, sentiment, which I talk about in every video. And as you know, it's a contrarian indicator. So when people become super bearish is usually when the bottom is in. Right here is the advisor sentiment chart, and you can see that there hasn't really been capitulation yet. And in our opinion, this investor's intelligence sentiment indicator provides the highest signal to noise out of all the sentiment data. So without capitulation, with the red bearish line reaching the green bullish line, it tells us that this down move probably isn't over. Now, to make a bottom, you don't necessarily need full capitulation. You don't need that entire sentiment reset. But if you see it, you can be a lot more confident that the bull is resuming. So Stan Druckenmiller, he often talks about how the market is smarter than he is, and that he listens to the signals of the market to figure out which side of the trade he should be on. And one of the best signals in the market is looking at cyclical versus defensive stocks. So this chart right here shows cyclical versus defensive stocks, and that's the orange line that you see. And then the S&P is the blue line. So when the orange line is trending up, it means that cyclical stocks are outperforming defensive sectors. This means that investors are moving to more risk-on positioning because they're more optimistic about future economic growth. But when the orange line trends lower, it means that investors are more defensive. So they're switching their positioning around because they're more pessimistic about the market outlook. Now, what we normally want to see is the trend in cyclical versus defensive names confirm the trend of the broader market. You don't want to see a divergence, because when there's a divergence between these two lines, that often means that the market's internals are shifting. And if they're shifting, we're going to see a big move in price one way or another. And as you can see right here, the orange line is diverging from the blue line. So the first thing we want to see is this orange line, this cyclical versus defensive, put in a higher low, because putting in a higher low is a signal that there's a shift in the market internals happening. And that gives us more confirmation that an actual bottom in the stock market is in. And one last thing we want to look at is credit, because when it comes to the hierarchy of traders, bond traders are usually the smartest. They know where things are going. So this is why moves in the credit market almost always come before large trend changes in the equity market. So just like we saw in 2016, we want to see that orange line hit a bottom and move higher. Without that, it's unlikely that this stock rally has any legs. And that orange line, by the way, is investment grade bonds relative to USTs. So we need credit to make a bottom first, and then we should see equities do the same. So all in all, this rally we're seeing right now is pretty nice, but don't expect the bull to fully resume so fast. It's going to take a while to work through the massive moves we've just seen. So at this point, we're expecting another move lower, or we could see some prolonged sideways action. Either way though, this is still a great opportunity for stock picking because there's lots of discounts. But we're being careful not to go all in because we see the potential of another down move. But as long as we all follow our strategies and adhere to our risk management, we should be fine no matter what the market does. That's the point of having a strategy, right? And having a strategy also helps keep you away from feeling things like FOMO. Which, by the way, if you're feeling FOMO after this massive move we just had, then definitely check out this guide that we put together, because you really shouldn't. Just click the link in the video or the comments or the description. I'll put it everywhere, and you'll go to a page where you can enter your email so I know where to send the guide. It's free. That's just one great thing about it, but check it out. And if you haven't already, make sure you subscribe to this channel and hit that bell so you get an email notification every time a new video is published. Subscribe, and I'll see you in the next video. Bye.